Hello, my name's Tracy Savage from BARBRI, and I just wanted to give you a brief explanation of the way to calculate income tax step by step. Now, in the assessment, it's unlikely that you'll have to do a full income tax calculation for one question, because that's quite a task to ask you to do for 1 minute and 40 seconds. However, you're likely to be asked to do small slices of the calculation, so different individual bits. But it might help to actually see the whole of the income tax together, so that then it makes it easier to do those small slices. And unfortunately, our tax system is very complex and unwieldy. That's basically a result of an awful lot of tinkering around the edges, with successive chancellors making small amendments at budgets rather than sort of changing the rules completely. But it is what it is, okay? And we have to get through the tax questions and be able to make a good stab at them to be able to do well in those questions in the assessment. So, as much as you might think that it's not the most clear-cut and easy system to use, which I would agree with you, we don't have a choice. We have to use the tax system that we've got, and it's a multiple choice exam. We can't discuss how we would change it or evaluate it. We basically just have to use those rules. And I think the best thing to think about in relation to tax is just to consider it really as a recipe. So all it is a recipe that you actually have to follow with various steps, but it's a recipe that you have to follow exactly. So you can't change things. You can't be creative and think that you're going to add a new herb or spice, or you're going to change the composition of the ingredients as between each other or something like that. That just won't work. So you've just got to learn the recipe and use the recipe exactly as it says. So absolute, teaspoon for teaspoon, pinch for pinch. You can't be creative of it at all. But it is basically just a set of rules to follow. So I've set out there the list of the sort of steps that you have to take to do an income tax calculation. And you start off by calculating your total income. So you add up all of the money that you've got from different sources, that is income money as opposed to capital gains. And then you can take off any allowable reliefs, take off any personal allowances, and then you've got to separate again. Although you already added it up, you've now got to separate it and separate the different sources of the income into savings and dividend income, and then income from any other source. And then you tax each type of income separately. Again, a little bit more complex, but that's just what the rules are. Ultimately, you add together all of the tax that individual owes, and then you take off any tax that they might have already paid to work out their total tax liability. So if we just go through these steps and look at how they actually operate. So the first thing that you have to do is calculate the total income. And your study guide goes through this and gives you various different examples of what types of income that there could be. So I've just put a few up there. So trading income, so that would be income that you made from a business, either as a sole trader, or it could be income that came in from a partnership, for example. You might get property income. So if you happen to own property that you rent out, that would be property income. You might get savings and investment income. So if you have any money in a bank or building society, currently at the moment you probably won't get an awful lot of income, awful lot of interest in that situation, but you might have some interest that comes in from those savings. And then investment income is generally talking about dividend income. So if you own any shares and you've received any dividends paid from those shares in that year, that would count for investment income. And then you come to the income that I suppose most of us are most likely to have, which is income that we get from our employment. So I'm employed by BARBRI, they pay my salary, and also I have to pay tax on that salary. But that is my source of income. And you might also have pension income, depending on your age, if you're retired, or sometimes people now will take their pension and continue to work as well. So that could be another source of income, and there's some others set out in the study guide. So you add together all of these income that you could have from different sources to get your total income. And remember that you only actually pay income tax if you've earned money. Okay, and that money can come from all of these different sources. And the reason that you have to look at them all separately to work them out is that each source of money comes with its own rules, and the way that you work out how much money you've actually received from those various different things has its own rules and its own reliefs and that sort of thing. So you will probably be given most of those figures in a question if it's relevant. You might get a question on working out trading income, and I'll go through a couple of the most complex areas with that in a moment. But basically you start off by adding together all of those income sources that you've got to get with your total income. Okay, some of those sources might come with tax already deducted. So the most common situation that is employment. So you know, don't you, that if you're paid, so say you get a job and they say that they're going to pay you £24,000 per annum, and then you get paid at the end of the month, and if you go to your bank account see how much you've been paid, then you know, it might be a little bit of a shock, but you don't actually get £1,000 because instead things have already been deducted from it. The most common things here would be any pension payments, also national insurance, and also tax, which is deducted from your employment money under the system called Pay As You Earn, PAYE, which means that you don't have to account for that tax to HMRC. Instead, your employer pays it direct. And the government much prefers that type of way of collecting tax because it's much less likely that there's any slip between somebody earning money and them paying tax, because they never actually get the money to then have to pay the tax on it. Instead, the tax is paid direct. Now, when you're adding together your total income, you add up the gross figures, so not the actual money that you get in your bank account every month, but the amount that you've actually received on your employment that is payable to tax. That can be a little bit complex to work out because, as I say, you've probably also had things like pension and national insurance money taken off, so it's not necessarily the you know, your overall gross salary. It might be adjusted slightly, but again, you'll usually get those figures in the question for you. So as I said, that's total income. Now, I did say that I'd talk a little bit about trading income and how you actually work that out. So trading income, so this would be income from a business. For that, you look at the chargeable receipts, and the chargeable receipts are the money that the business has actually made. So how much it has made from selling its goods or services, depending on whether it's a business that sells services or a business that sells goods. So those chargeable receipts are of an income nature. So the money that's coming in from selling whatever it is that that business does, whether it's a solicitor which sells effectively solicitors' time, you know, their profit costs, or whether or not you're selling goods to your customers. So all of those chargeable receipts are all of that money that the business has actually made from its trade. And from that, you can deduct deductible expenditure. And deductible expenditure is expenditure of an income nature, which is being used wholly and exclusively for the trade and is not prohibited by statute. So it's income expenditure. So that's not capital expenditure. So you can't ever say, oh, these things are always one or the other. Some things are usually one or the other. So things like rent, electricity, gas, salaries that you pay your employees, that sort of stuff will be deductible expenditure. But sometimes you have to look a little bit carefully at the type of business that you're actually running. So if you're a solicitor's business, for example, if the solicitor's business actually had some cars that belonged to the business that perhaps their employees used if they were going out to court or to see a client or something like that, and the solicitors business sold one of those cars or bought one of those cars, that's not going to be an income nature, is it? That's capital, because that firm doesn't make its money by buying or selling cars. Now that would be different if in fact you were looking at a business that was a used car salesman business, because that's how they make their money, by buying and selling cars. So sometimes you just got to look at the nature of the business to actually decide what's going to be a deductible expense. So you have all of your income, all of your income receipts, and then from that you take off any expenditure that you've spent from on behalf of the business. And then you're also allowed to take off capital allowances. And capital allowances are generally something which causes people problems when they're trying to work out what on earth that's talking about. And capital allowances are basically a sort of almost a sort of policy reason behind them, that the government will, and these vary from time to time depending on what the government is trying to encourage its citizens to do, but it's things which the government is encouraging businesses to spend money on, usually assets, that sort of thing. So things like plant and machinery. And a government would want a business to buy more plant and machinery, because generally that would make the business more efficient, more productive, and possibly at the moment that machinery might have less climate change effects. It might be, more carbon neutral, that sort of thing, less polluting. It could be that a government wants to encourage people to invest in IT style situations, that type of thing, to bring the business more up to speed. And so it gives these capital allowances which encourage businesses to buy these particular assets by giving them a tax relief for doing so. And the idea then is that really if that business actually invests in those particular assets and buys those assets, then that will be better for that country as a whole. So it will either make the business more efficient and more productive, and therefore make it make more money, and ultimately that means that whoever owns it will pay more tax on those profits, or like I say, it could be something that they're trying to encourage climate change style situation, and encourage people to buy things which have a better effect, less pollution, that sort of thing. So what happens with capital allowances is it enables you to claim some of that money that you have spent on that asset and set it against your income profits to effectively reduce your income profits in that year, which then means that you'll end up paying less tax. So from the business's point of view, it means that the sum that is expended is not quite as expensive, because it might have spent that money on that particular asset, but then it won't be paying as much tax on its profits. So it gives it a little bit of a sort of push to actually do that thing. So let's just look at how capital allowances for plant and machinery work, because all of the others work in a very, very similar style way. So with capital allowances, at the moment for plant and machinery, you've got two types of capital allowance. So the first one is the annual investment allowance. And that means that if you spend £1 million or up to £1 million on plant and machinery, then any amount up to that £1 million is deductible. That means that you can use it to reduce your income profits that you're going to be paying tax on. Okay. If you buy something that's more than £1 million, then you would get the normal writing down allowance, which is 18% on plant and machinery, in excess of £1 million. Okay, and any machinery that you've already got, you would get 18% of the value of it every year as a writing down allowance. And obviously that will be decreasing. So I've got an example there. So those of you who've watched the business videos, you can remember that I'm constantly talking about my cake making business. So let's use that. So if I bought a cake mixer, a very, very big cake mixer, I'm assuming, if I spend £1.5 million on it, and say that I already own other assets, so ovens in this case, that are worth £250,000. So I've bought something this year that's £1.5 million. So I can claim the annual investment allowance of £1 million against that purchase. But I've still got £500,000 left. And so I can add that to my existing assets, 250,000. So that gives me 750,000 worth of assets. And for that, I can get the normal 18% writing down allowance this year. So that means that I could in total claim a writing down allowance of £1,135,000 this year. So that would reduce my profits by that amount. That means I'm not going to be paying tax on that amount of profits. Now next year, this year I had £750,000 worth of assets that I hadn't claimed a writing down allowance on. And I've just claimed 135,000 this year. So next year, I wouldn't be able to claim against 750,000 because I can only get the writing down allowance once. So I'd have to reduce the value of my assets. So there's £750,000 this year. Next year, I would take that £135,000 off those assets. So next year, I would be claiming 18% writing down allowance on £615,000 worth of assets. And then the year after, it would be reduced again and again and again. But basically, I could keep claiming that 18% writing down allowance against that reducing balance of my assets until it had theoretically gone down to zero, or until I sell those assets at some point in the future. So that's how capital allowances work. So you have your trading profits, to work those out, you take your chargeable receipts, all of the income from the business, take off all the deductible expenditure from the business, and then take off any writing down allowances. And that will give you the trading profits, which is basically the amount that's going to be charged to tax. Okay. So we've got our total income. Remember, that was all of our various different income sources added up together. And from that, we take away any allowable reliefs, and that gives us our net income. So allowable reliefs are things that you can reduce your total income by. And the three most common ones really are qualifying loans. So we've got loans for a partnership. So that would be if you borrowed money to actually buy a share in a partnership, to contribute capital towards a partnership, or to make a loan to a partnership, then the interest that you pay on that loan, you can deduct from your total income to reduce it down to your net income. You can also, if you're borrowing money and paying interest on any money that you've borrowed to invest in a closed trading company, and also any interest that you might have to pay on a loan to personal representatives to pay inheritance tax. So the interest that you pay on those qualifying loans is again reducing the total amount of income that you've got that you're going to be paying tax on, because we have our total income figure, we take off any of those allowable reliefs, and that gets us down to our net income figure. Okay. Now, once we've got our net income figure, then the next thing that we're going to be looking at is what about any personal allowances that we can use. And personal allowances are basically an amount of money every year that the government allows you to reduce your income by. So it's effectively a sort of 0% tax on that first amount of money that you earn. And it's taken off your income, but there's a queue of who gets the personal allowance first. So first of all, any non-savings and non-dividends income uses the personal allowance up. If you've still got personal allowance left after you've taken that off, then you would set your savings income against it. And if you've still got any left at that point, then you would set your dividends income against it. There's also marriage allowance that enables you to transfer up to £1,250 of your personal allowance to your spouse or civil partner, so long as your spouse or civil partner, i.e. the recipient, is not a higher or additional rate taxpayer. And there are some other allowances mentioned in the study guide, blind person's allowance mentioned there as well. Now, there are also personal savings allowances for interest and for dividends. And I've put them down there as the figures. So if you're a basic rate taxpayer, there's £1,000 for against interest and £500 if you're a high rate taxpayer, and then the dividend allowance is £2,000. No matter what type of taxpayer you are. Now, those are personal savings allowances, but they're a little bit confusing because they don't actually come off at this point, and instead we use those interest and dividend allowances when we actually come to work out how much tax will be paid on our interest and on our dividend income. Okay, so we'll come back to those in a moment. Okay, so we've now got our taxable income because we've taken off our personal allowance. Possibly if we transferred anything, if we had received a transfer from our spouse or civil partner, any marriage allowance, blind person allowance, whatever, that gives us our taxable income. And once we've got our taxable income, then we have to split it into non-savings and non-dividend income, and then also savings and dividend income. And you might think, well, why are we doing this? We just added it all up before, now you're asking me to split it up again. That's just the way that it works, and it's because the tax rates are different depending on what type of income it is. And again, it's just another complexity that we actually have in our tax system. There's nothing we can do about it. So we have to split it up, and the first thing that you do is you take off any savings or dividend income from that taxable income figure. So if your question told you that this person had received any interest on savings, or had received any dividends in this tax year, you would take that money off the taxable income to leave the non-savings, non-dividend income behind. And we calculate the tax payable on that non-savings, non-dividend income first. And it's taxed at different rates. So the basic rate is the first £37,500 that you have after you've taken up your personal allowance. Remember, we already did that. If you have any money left after that, so if you've got money of, say, £50,000 at that point, then you're going into the higher rate tax band. You still get the first 20% at £37,500, and then everything that was earned between that amount and £150,000 is taxed at 40%. And then if you're lucky enough to earn over £150,000, then you will have anything over £150,000 will be taxed at 45%. Okay, so say I was incredibly well paid this year, and I got £200,000. Okay, then the first £37,500 would be taxed at 20%. I then pay 40% at the difference between 150,000 and 37,500. Remember, that first 37,500 has already been taxed. I don't tax it again at 40%. It's already been taxed at 20%. So that would actually be 112,000 at 40%. And then there would still be £50,000 left. Remember, I've earned 200,000, just taxed 150,000. So then that would be 45% on the remaining 50,000. So you take your first slice of 37,500, tax at 20%, anything above that, but below 150,000 at 40%, and then anything above 150,000 at 45%. But remember the bits that you've already taxed, you don't pay those again. Okay, so that's not too bad, I don't think. That's relatively straightforward. The next thing that we get into is savings income. So if you've taxed all your non-savings, non-dividend income, the next thing you've got to look at is, does your individual have any interest money that they've received on their savings? And if so, then we've got to tax that next. And that's because everything comes in order. You tax non-savings, non-dividend income first, then you tax savings income, and then finally you tax dividend income if you have any. Okay, if you don't have any savings income, obviously you go straight on to dividend income. But if you've got income from all sources, it's non-savings, non-dividend income first, then savings income, then dividend income. Okay, so there is a personal savings allowance. So the first £1,000 of savings is taxed at 0% for a basic rate taxpayer, and the first £500 for a higher rate taxpayer is taxed at 0%. Okay, so remember I said that the personal allowance for savings is taxed, comes in at this point, not earlier on when you're dealing with a normal personal allowance, and that's how it actually operates. Okay. And then the rates are, if your non-savings income after deducting your personal allowance is below £5,000, then the remainder of that £5,000 is taxed at 0%. Then if you have any of your basic rate band left, then it's at 20%, and then the higher rate, and so on. So it's taxed on the same sort of rates once you, but it's taxed as the additional slice. So if you've already used up your first amount of money, then you can't use it again. So if you've already, when you're working out your non-savings, non-dividend income, if you're already at £50,000, for example, then there's no base rate left. Then any savings that you get is going to be taxed at 40%. If you've got savings then taking you up to over 150,000, then it would be taxed at 45%. Not happening a huge amount at the moment because most people aren't getting a lot of interest on their savings. So you'd have to have some pretty substantial savings to be earning that amount of money, but that's how it actually works. Okay. So I'll just go through that again. So if the taxable non-savings, non-dividend income plus the personal allowance, the PSA, personal savings allowance, is less than 500,000, then the remaining taxable savings income will be taxed at the starting rate for savings. Any remaining taxable savings income over 5,000 would then be taxed at 20%. If your taxable non-savings, non-dividend income plus your personal savings allowance is more than 5,000 but less than 37,500, then the remaining taxable savings income below 37,500 will be taxed at the savings basic rate, and any remaining savings income over 37,500 is taxed at the higher rate, or ultimately the additional rate over 150,000. So I personally think that savings income and working out how to tax savings income is probably the hardest bit of the income tax calculation. So if you're unlucky enough to get that in the assessment, then that will be one of those times when maybe it might be one of those questions you want to flag and come back to at the end if you've got enough time to really sit there and work through it slowly. If you don't, it's one question. Okay, you're not going to get 360 questions on just this really, really difficult area. There's going to be one question. So even if you completely get it wrong, it's less than 1% of the exam. So don't stress about it, okay? If you can work it out in the exam, great. If you can't, just move on. It's one question. Hopefully there'll be other tax questions that you will be able to get right. So as I say, I think this is probably the hardest bit when you're working out the tax calculation. And then the dividend income comes next. A little bit easier for dividend income because everybody gets the same dividend allowance of £2,000. So you don't have to worry about what type of taxpayer you are, whether you're in a basic rate, whether you've gone up to the higher rate, whether you're in the additional rate. Everybody gets £2,000 for that. So that makes it a little bit easier. The thing that's a little bit more complicated is that you have different rates for that. So a 7.5% rate between 0 and 37,500, 32.5 between 37,500 and 150,000, and 38.1%. Why it's 38.1%, I do not know. Why we have to have decimal places in it, I'm not the Chancellor, I didn't set it. That's the rules, okay? I think it's quite likely you would get the dividend rates if they ask you to work it out, because it's probably something that a newly qualified person would look up, but those are the rates anyway. And remember, these figures are the last ones that you're using. So if you've already used your basic rate for your normal income or for your savings income, you don't get that 37,500 each time. You don't get 37,500 basic rate on your salary, and then another 37,500 for interest, and another 37,500 for dividends. And once you've used your basic rate, everything after that is going to be in the higher rate, or ultimately in the additional rate. So you've got to keep going back and going, well, if the taxable non-savings, non-dividends income plus total savings plus the dividends allowance is less than 37,500, then I can use the basic rate of 7.5%. Okay, but if the taxable non-savings and dividend income plus the total savings income plus the dividends allowance exceeds 37,500, then that dividend income is going to be taxed at 32.5%, and so on. So you only get the basic rates once, and it's your normal income that uses it up first, then savings income, and then finally dividend income. Okay, and that's how it all sort of works, that they're all in that queue. And the non-savings, non-dividend income has the first bite at the basic rate, then savings, and then dividend. So once you've got to a higher rate taxpayer on non-savings, non-dividend income, then you will already be a higher rate taxpayer on savings and on dividend income, and possibly even an additional rate taxpayer, depending on how close you are up to that 150,000 barrier. Okay. So let's just put that all together. So I've just taken a question from one of the multiple choice questions here, and it tells us that an electrician has trade profits of £85,000 and dividend income of £20,000. He also obtained a loan which he used to pay an inheritance tax liability, and interest payments for that are £3,500. Personal allowance for this tax year is £12,500, and the dividend rate is 32.5% for higher rate taxpayers. Okay, so what's his income tax liability? Okay, so what's the first thing that we do? Remember, go back to that list that I gave you on the recipe. What's the first thing that we do? The first thing that we do is we find out the total income, don't we? So here, the total income will be the trade profits plus the dividend income. So his total income there, £105,000. Okay, so what's the next thing that we do? So the next thing is to get to our net income. Remember, that's our total income less any qualifying loan interest. And here we know that he's got qualifying loan interest because it tells us that he's borrowed money to pay inheritance tax. So the interest that he pays on that loan, question tells us it's £3,500. We can take that off to get the net income figure of £101,500. Then the next thing we've got to do is to work out our taxable income. So that's net income less personal allowance. So net income 101,500. Now the personal allowance, it told us in the question, was 12,500. But again, another little complication, that if your income is over 100,000, then your personal allowance is reduced, and it's reduced by half effectively for everything over £100,000. So personal allowance normally 12,500, but he has earned £101,500, more than £100,000. So we've got to make an adjustment. So the way that we do that is we do the amount he's earned, £101,500, minus the £100,000 cap, and divide that by 2. So 12,500 minus that figure gives us 11,750. So his personal allowance is reduced down from £12,500 to £11,750. So that means that his taxable income is £89,750. So the next thing that we have to do is split that into non-savings, non-dividend income, and savings and dividend income. And here, he doesn't have any interest income in this question. He's only got dividend income. So we've got to reduce our taxable income by the £20,000 that was his dividend income, and that means that his non-savings, non-dividend taxable income there will be £69,750. Okay, so we're going to tax that at the appropriate rates. Remember, we start with our non-savings, non-dividend income first. So the first 37,500 is taxed at 20%, and then anything above that and below 150,000 is taxed at 40%. Now we've already taxed the first 37,500 there, so we will now have to adjust the rest of the figure to find out how much we're going to tax at 40%. So the total figure was 69,750, but we've already taxed 37,500, so we don't do that again. So that means that it's the difference between that we're taxing at 40%, which is 12,900. So the tax on the non-savings, non-dividend income is £20,400. And then we've got to work out the tax on the dividends. So the dividends are £20,000. Remember, everybody gets a dividends allowance of £2,000. So that means that the taxable dividend figure is 18,000. And we already know that there's no basic rate tax left because he's already used up his basic rate band when we did his taxable profits. You know, we did his non-savings, non-dividend income. So that means we're going to be taxing that at 32.5%. We're not yet up to 150,000, are we? So it all comes within that higher rate rather than that additional rate. So that means the tax on his dividends will be £5,850. So the total tax payable here is 20,400 plus 5,850, so his total tax payable is £26,250. Now, if he had already paid any tax, he hasn't, the question doesn't tell us that, but if, say, some of that income had been from salary and you've been paying pay as you earn on it, then to find out how much he would now owe HMRC, you would take off any tax that had already been paid to have his final tax liability, because that's the tax that's payable. But any tax that he'd already paid, it would reduce that amount. So that's a basic guide to income tax, and I hope that that has helped you to understand how the system actually operates.